What's up everyone, it's Karthik with MoneyVest. Traders build their biggest net short position on US Treasuries and are also pricing in for over 240 basis points worth of cuts. So interest rate cuts are indeed priced in at a very aggressive level, and again, the largest short position coming in for US Treasuries. We're also going to talk a little bit about the CPI data and some other really interesting charts that I want to share in this video. As always, make sure that you drop a like, subscribe to the channel, and please do me a favor and share these videos with your friends and family, other traders, investors that can benefit from the message and the value in this video as well. And also, if you want to keep track of my options portfolio, link's going to be down below. I sold options yesterday for expiring this weekend, basically on Friday, so that's when the expiration is. And I recorded another update for all the members earlier today, so about an hour ago, I posted my week 3 options portfolio update and the trades that I've placed for this week. So if you want to get access to all of this, link's going to be down below. Would love to have you on board. On top of that, you get access to the entire MoneyVest platform, as well as all the Discord channels and members-only private videos. There's a different tier, MoneyVest Education, if you want to get access to all 4 courses with over 172 pre-recorded videos on fundamental analysis, technicals, options, and psychology of investing as well, which I think is very, very beneficial. So this is where we are. The Fear and Greed Index, according to CNN, we are back in the fear zone. Makes sense because the markets have, of course, sold off in the first week of September. We did see a little bit of a relief rally yesterday. Markets pushing back up over 1%. But I want to be very clear, we're not out of the woods yet. We're not in the clear just yet because of a technical rebound, which we were already expecting on the back of these oversold conditions. Majority of stocks were back trading below their moving averages. So this is a very normal sort of dead cat bounce, or a little bit of a technical rebound if you wish. But it's not a trend setter, right? It's not really suggesting for any trend formation at the moment until we take out some of those previous highs, which again, we have discussed in our previous market updates and technical updates. And we'll also talk about that in our future videos as well. Now, this right here is the interesting piece that I want to break down, which is traders are now pricing in for almost 240 basis points worth of Federal Reserve cuts. And you can see how expectations have really accelerated to the upside, where again, traders and investors are now pricing in for significant rate reductions. And as a result, as the expectations continue to go up for rate cuts, they are now also speculating on the biggest net short position, the largest net short position in 10-year treasuries in history. We're talking well over 250, as much as over 300,000 contracts. That is a lot. And this right here is the overall reduction we're seeing in the leveraged funds, which is long minus shorts for 10-year futures, asset manager and institutional longs minus shorts for 10-year futures, and asset managers institutional plus leveraged funds total. You can see that they have created some very significant bets on the short side, expecting for rates to come down on the US Treasuries. So as we know that interest rates are expected to come down in the next Fed meeting, which is going to be in the next 9 days, we're going to listen from the Federal Reserve about their first rate cut. We already know the market's priced in for a full-blown rate cut. We just don't know how long or how much they're going to cut rates by, 25 or 50 basis points, but it's pretty much a done deal at this point. And the future of rate cuts really just depends on where we are with unemployment and inflation as well. So speaking of CPI, and a lot of that is also going to depend on recessionary factors as well. So this right here was from one of the economists, Joseph. He says, and I quote, "Good morning. The August CPI report will present further evidence of price stability, which underscores falling yields across the curve and the policy pivot towards lower rates by the Fed. We expect below consensus 0.1% month-over-month increase in the CPI, with a year-ago rate increasing to 2.5%. That is actually going to be lower than 2.6% consensus and significantly lower than the 2.9% where we are at the moment. And this is primarily due to the decline in gasoline prices, which will drag down the top line in both the August and September data. Of course, the housing data will also play into the result. We expect 0.2% and 3.1% reading in the core CPI as well. Now, I do agree with this type of analysis because I do believe the gas prices have been trending lower, because we've seen gasoline, oil prices in general, 2 consecutive months in a row, August and September, they've continued to come down, which is going to be beneficial for for inflation readings, and you'll notice that core services have now taken up a bigger piece of the overall inflation picture, because earlier you'll notice that we were, of course, seeing mostly inflation driven by goods, right? So product inflation, and energy was also a pretty big deal. So you can see the red bars here, and that has clearly diminished significantly as time has gone on, and we've now only really seen core services and a little bit of core goods now left for inflation. Food prices have stabilized. Energy prices have come down. They're now in deflationary zone pretty much. They're flat on a year-over-year basis. And shelter prices, of course, are still going to be very, very important. They're going to be the one that actually moves the needle to above expectations, below expectations, what's going to be that beat or miss when it comes to CPI. Now, when it comes to the economy, there's a few other alarming indicators that I really want to point to. The first one's going to be construction job openings. And the reason why this is so important is because every time we see construction and manufacturing, these are the two really important indicators, construction, manufacturing, right? If they start coming down, if there's job openings going down or employment going down for these two industries, that is a very clear signal of a slowdown in the overall economy, because construction and manufacturing is how we build stuff. Construction, how we build real estate and infrastructure. Manufacturing is how we build products, right? Actual goods, right? So if those two sectors are falling off, in other words, the job openings or the employees, or we're seeing job losses in those two particular sectors, I think it's really important, more important than any other sector out there. So this right here, you'll notice a sell-off, recession followed, sell-off, recession followed. This right here, sell-off, recession followed, although a very, very short recession, but it did follow, right? So 3 times I can show you here is when we saw construction job openings come down as real estate companies, infrastructure, government agencies, they're not hiring construction workers anymore. A recession has followed, and they're the leading indicator in terms of the slowing down in the overall economy. And well, guess where we are now? We are seeing a very, very sharp decline here in construction job openings. Is a recession going to follow? Well, we're going to find out very soon, and that's going to play into the overall interest rate policy as well. This right here is employees in manufacturing. Once again, you'll notice as we see a decline, recession follows, decline, recession follows, decline, recession follows, decline, recession follows, decline, recession follows. It has played pretty much perfectly every single time. A couple times over here. Again, you'll notice we're seeing a normalized employees, we're seeing normalized employees, boom, boom, boom. Every single time we've seen a recession, every time both construction and manufacturing jobs have fallen off. Now, for manufacturing, we're starting to see a little bit of a flat line here. We were growing really well, but now we're starting to kind of go sideways. So if that number starts to come down, along with construction employees coming down or job openings coming down, it's going to be a pretty leading indicator for us to better understand, okay, a recession is indeed here. We're seeing a significant weakness or slowing down in the overall economy, which is going to once again play into the interest rate cuts, more expectations for rate cuts because the economy is slowing down. And if we get a very strong CPI number, CPI report, that is indeed going to put the Federal Reserve on a very good, strong footing where they're like, okay, inflation's coming down 2.5, 2.4. We're coming closer to the Fed's target. And now we can actually start coming off of that restrictive policy stance and start cutting interest rates a little bit more aggressively also, right? That's a possibility for the Federal Reserve. Now, coming over to some of the other charts that I want to break down. And this is the overall ownership breakdown of U.S. equity markets. And we've seen a significant increase, of course, in the households, 39%, hitting a new all-time high. Passive mutual funds, 6%. We got ETFs at 8%. Active mutual funds, 12%. And that has actually come down. So, makes a lot of sense because active mutual funds, they actually tend to not beat the market, but yet charge very, very high fees. So that as a percentage of the overall equity markets, they've come down. Pension and government retirement funds at 9%. And we have seen a significant increase in foreign investors. We've seen a lot of interest by foreign corporations, companies, and individual investors, 17%. And that has actually gone up really, really well. And hedge funds and business hedges have also been a little bit more on the flatter side ever since 1945. So households, individual investing, passive mutual funds have increased. ETFs have also increased, but active mutual funds have gone down, and significant increase in foreign investors in the U.S. markets as well. And there's a couple more indicators that I want to break down that are very, very helpful are going to be number one, the market regime indicator by State Street and kind of Bank of America. They've built it together. It's a proprietary macro indicator developed by SSGA, Investment Solutions Group. And they look at a lot of different types of data to help us better understand where we are in this market cycle. And they have a reading between 0 and 100%. If it's at 100%, it's at crisis mode, right? So we're in extreme risk aversion, meaning investors do not want to take on any risk assets. We're in severe panic or fear. And then again, anywhere closer to 0%, we are in extreme euphoria. There's a lot of greed, significant risk appetite, and there is greed and complacency in the market. And anywhere in between, we're going to be from high risk, low risk to a more normal level. And this was as of the second quarter 2024. And you'll notice that we are right now sitting at just about low risk aversion, meaning that we're not at a level where there's high risk aversion. People are not flooding away from riskier assets, but we're also not in greed or euphoria. We're kind of in a low risk aversion where people are taking on risk, but at the same time, they're not super cautious, but they're also not super greedy at the same time as markets have normalized a little bit. Now, this is not the most up-to-date reading. This is as of June 2024. So July, August, September, we're going to get the new reading after September ends. And I'm assuming it's going to most likely be around this normal level. It's going to most likely push back above this normal zone where investors are, once again, we're seeing that sell-off. Last couple months have been pretty brutal in terms of volatility. So it's possible that there is a level of risk aversion in the market where investors are in general moving away from equities and of course technology sectors over to utilities and staple as well, right? So that's very, very defensive part of the market. So I would not be surprised if this indicator is back higher. And once again, if you kind of really take a look at how this is traded in the past, I mean, we have pretty much picked out some tops according to this market regime indicator. Over here 2007, 2008, over here 2012, 2015, we got 2018, we've got 2022. So we got a lot of times when there was high risk aversion has usually end up being a very good buying opportunity for the markets as well. And every time we've been at these lower lows, like in the euphoria or the low risk aversion places, that's been the time when the risk reward was obviously not that good. It was very unfavorable, and it was usually the time to be very cautious, very alert, and stay away from the market because there was extreme greed in the markets. And it's kind of plays into our money vest index as well, because that has also been a very good indicator for us to better understand how the risk reward is in the market. It's kind of like very similar, but just built differently, although tracking something similar from a more macro perspective, but our money vest index is a little bit more technical. Now, this right here is also Goldman Sachs bull bear market indicator. So very similar to the ones that I just showed you. Is also, it's actually very recent. It's now trading at over 70%. And this is also indicated the bull bear market here, and the world bear market also is presented. And every time we've kind of gotten up to those levels, those are some of the red readings at 70 to 100%. We have seen the markets, of course, fall off a cliff after, right? So again, these are some of the higher levels, and we are once again at well over 70% right now. Something to keep in mind. Again, the risk reward is, in my opinion, decent, not the best, but also not crazy unfavorable. But I'm just patiently waiting for better and better buying opportunities. That's why I'm in the opportunistic sort of area where I do have, 20%, 22% cash exposure right now, and at the same time selling more options, running the wheel strategy to generate some more cash so I can buff up my cash exposure for when the markets do end up, let's say, selling off a little bit further. That's going to be very, very good opportunities in terms of that risk and reward ratio. We've talked about the S&P 500's valuation on our channel before. We've got a spreadsheet that we've been tracking with. 21.2 times is the current next trailing 12 months price to earnings, and we are in the 92 percentile right now. And if you take a look at the equal weighted S&P 500, we're in the 89 percentile 17 times. That's a P multiple. It's a significant difference between the market cap weighted versus equal weighted. And the other 493 companies, in other words, excluding 4 Magnificent 7, we're at 19.1 and we're in the 84 percentile. So it just goes to show how much of a weight the Magnificent 7 stocks have and how much they're pushing that percentile higher for S&P 500 in terms of its market cap, in terms of its pricing, right? Overall valuation. Magnificent 7, we're in the 29, almost 30, and we're in the 80 percentile, and the NASDAQ 100 is at 27. Of course, NASDAQ and Magnificent 7 trades significantly at a more expensive valuation compared to S&P 500 or the equal weighted index, but on a percentile basis, we're actually lower than the S&P 500. Now, this right here was actually a very, very good chart from Bank of America that I wanted to go over, and this is showing us the potential for higher tax rates and how that's going to affect all the different earnings for the different sectors and the companies. And they estimated that an increase of higher corporate tax rates, which by the way, we know that 2025 is going to be the end of those corporate tax cuts that Trump sort of instilled in the economy back when he was president. And that's going to be an estimated hit of 5% on earnings per share. So hit to EPS is going to be right over here, about 4.7%. So that again plays into the market because as we know, the market really cares about the bottom line, that's profit and earnings. And if earnings actually get affected, the market's valuation is going to be reset a little bit, right? So 4.7% you can expect if there was like a one-to-one correlation for the markets to also see that 4.7 close to 5% pullback to readjust for that valuation. Now, this right here is also U.S. equities versus commodities are also hitting a 2.5-year high. I also do believe that, there's possibility that there's going to be a bit of a pullback in equities relative to commodities. Not saying that equities are not going to go higher, but there is a possibility that we do see a little bit of that underperformance in equities relative to commodities, relative to the, silver and gold and, commodities that I've mentioned before because of the significant flight to quality away from equities over to more safer, more defensive asset classes. And also, gold tends to be very liquid, very tangible, very, very good store of value in my opinion. So, I don't mind putting 5, 7, 10%, even 10% of my net worth into gold, something that I do know, in my opinion, will hold its value. It's going to be very liquid and will continue to perform well with the limited supply that we have. So in my opinion, I think commodities is one place that investors can look to diversify a little bit in these times of crises. And finally, coming over to small business funding rates, which have also hit their highest levels in 22 years. Small businesses are definitely struggling. So IWM, mid-cap, small-cap, the prime funding rate sitting at well over 5 to as much as 7%, something that we did not see until September 2007. So a repeat of 2008, again, we'll find out because that was again the cornerstone. It's kind of like the bedrock of U.S. jobs sort of market because small business is very, very critical to the functioning of the overall economy. And they're the ones that actually do a lot of hiring because there's significantly more businesses, small businesses, than there are large businesses. And while large businesses do hire a lot of employees and, a lot of them can be outsourced over to India or other parts of the world, it's really small businesses that don't have the exposure to outsource a lot of their work overseas that hire locally. And they're the ones that are actually the true bedrock of an economy. Small businesses, medium businesses that are hiring locally. And they're actually the ones creating employment, right? Creating jobs. And if they're not able to do that, if interest rates are so high, then what happens? Unemployment actually increases. And if you actually put this chart alongside unemployment, you might see a stark difference where as small businesses funding rates collapses on the back of rate cuts because of a recession, unemployment skyrockets during that time because small businesses are struggling with higher interest rates. They can't hire anymore. They can't pay those wages or salaries anymore. Maybe some of them are going out of business. Bankruptcy rates are already hitting higher levels, I think, since 2017. And so unemployment starts to increase. That puts us into a recession. And then rate cuts actually eventually happen. So keep a close eye on this as well. Very, very important indicator. So that's where we are going into, this week's inflation data. I think it's really important to keep in mind that we are not out of the woods yet. S&P 500's got a big support level here at 5,400 and a very strong resistance up to 5,563. And QQQ's also support level sitting roughly here inside this green rectangle. We are down about 30 basis points pre-market, and the resistance that we're kind of battling off of intraday at 454 for the NASDAQ. So hope you all enjoyed this video and a complete update on the markets. Make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. 16% annual discount is available until the end of this month. That will give you access to our entire community, all the members-only private videos, as well as my options portfolio. So links going to be down below. As always, happy investing. I'll see you all in the next video.